Most people are watching crypto the wrong way. They're watching the Bitcoin price. They're watching meme coins. They're watching influencers argue over which coin pumps next. But the bigger story is happening behind the scenes. Crypto is moving from speculation to infrastructure. And if that sounds boring, that might be exactly why people are missing it. Because the biggest shift in crypto right now is not another 100x meme coin or the Bitcoin price crash. It might be crypto becoming part of the financial system itself. Every cycle, retail asks the same question. What coin is going to pump? When Bitcoin 100k? When Moon? And I get it. That's the exciting question. That's what gets adrenaline going. That's the question that gets clicks. That's the question that makes people feel like they're one trade away from life-changing money. But institutions and traditional finance ask a different question. They ask what rails are being built, what rules are changing, what infrastructure is becoming usable, and what can actually scale. And right now, the rails are changing. The Clarity Act recently cleared the Senate Banking Committee 15-9, while the Bank of England is preparing draft rules for systematic stablecoins. And the ECB has also been discussing stablecoins inside the broader future of money debate. The UK has also been building toward a formal crypto asset regulatory regime. This is part of crypto that most people find boring, but it's also the part that decides whether crypto stays a casino or becomes infrastructure. Now, when people hear crypto regulation, they usually think one thing. Regulation is bad. They think restrictions, they think lawsuits, they think governments trying to kill crypto. And sometimes, yes, that is exactly what it feels like. But there's another side to this. Because serious capital usually doesn't move at scale into unclear environments. Pension funds, asset managers, banks, payment companies, public companies, they need rules. That doesn't mean that every rule is good. It doesn't mean every regulation is always right. And it definitely doesn't mean crypto should just become another version of the banking system. But it does mean this. If crypto gets clearer rules, then bigger players can start building on top of it. And that is the shift. Crypto regulation might not be the end of the story. It might be the start of the next phase. If Bitcoin was the first big crypto narrative and DeFi the first big crypto experiment, stablecoins might be the first crypto product that actually goes mainstream. Because most people don't want volatility when they're making payments. They don't want to send money today and find out that it's worth 20% less tomorrow. They want dollars, GBP, speed, they want low cost, global access, and they want settlement fast. And this is where stablecoins become interesting because they are not a speculative asset. They are financial plumbing. And this is why regulators are so focused on them suddenly. The US is pushing stablecoin legislation. The UK is preparing stablecoin rules. The ECB is talking about stablecoins in the context of money itself. And companies like Circle and Coinbase sit right in the middle of that shift, alongside some other big players such as Solana and other L1s. The ECB has now claimed stablecoins sit under the regulatory parameter of MiCA. The Bank of England is in discussion and debate about draft rules for systematic sterling stablecoins. Recent coverage has linked US crypto legislation to stablecoin issuers and AI payments. And once you understand stablecoins as rails, you stop asking, what does this coin do? And you start asking, what does this system enable? Now, the second piece of this is tokenization. And I know that word sounds like something a consultant says in a panel before everybody starts snoring. But the idea is simple. What if financial assets could move like internet assets? What if bonds, treasuries, private credit, real estate, collateral could settle faster, move globally, and be used inside programmatic markets? This is why banks don't need to care about your favorite meme coin to care about the blockchain. They care about settlement, collateral, liquidity, efficiency. They care about markets that don't shut down at 5 p.m. And this is where the narrative changes. Crypto is no longer just people trying to replace finance from the outside. Parts of finance are starting to move on-chain from the inside. And then there's one more layer, AI agents. Because if AI agents are going to start to do things on the internet, buy services, pay for APIs, hire compute and subscribe to tools, move value between systems, they need payment rails. And the current banking system wasn't really designed for this purpose, to move tiny amounts of value across the internet, but crypto was. And this is why Stablecoins and wallets are now being redesigned for a world where humans may not be the primary users. Recent reporting has argued that stablecoins and wallets are being redesigned for systems where AI agents may become major users of crypto-native settlement infrastructure. Broader 2026 trend reports also identify AI agents, stablecoins, and tokenization as overlapping crypto themes. And this is where it gets interesting, because crypto might not be money for people. It might be money for machines. The mistake retail often makes is thinking every crypto cycle has to look like the last one. The last cycle was NFTs, before that it was DeFi summer, then it was ICOs, and before that it was Bitcoin itself. So people look for the obvious mania. But sometimes real opportunity starts before it looks exciting. It starts in regulation, in infrastructure, in custody, in boring payment rails, and in tokenized treasuries. It starts in stablecoin settlement. It starts in stuff people ignore because it doesn't look like a pump yet. And this is where market psychology matters. Retail wants confirmation. Institutions want positioning. Retail waits for the chart. Institutions watch the rails. Reddit discussions around 2026 crypto trends show some community focus shifting away from short-term price action and towards developments that could make markets more mature, liquid, useful and credible. Exactly the kind of framing this video can tap into. And that's why this moment matters, because the question may not be, when does crypto pump and when does Bitcoin stop dumping? The better question might be, what part of crypto become financial infrastructure? So if the thesis is right, who benefits? And I'm not going to say go buy any of these. This is not financial advice, but these are buckets that I would pay attention to. The infrastructure buckets. Exchanges become more important if crypto rules get clearer. They become gateways. They become custody providers. And they become institutional access points. They become the bridge between traditional finance and digital assets. The second bucket is stablecoin issuers. If stablecoins become payment infrastructure, then issuers, distributors, and networks around stablecoins become strategically more important. The third bucket is layer 2s and settlement networks. If more activity falls on chain, then cheap, fast settlement layers matter. This is where L2s, app chains and high throughput networks become part of the infrastructure conversation. If real world assets move on chain, you need platforms that can issue, manage, custody, settle and verify those assets. And finally, the last bucket, compliance, custody and data. Also sounds like the least sexy bucket in the world, but perhaps one of the most important. Because if institutions enter crypto, they need custody, compliance, risk systems, analytics, data, reporting, insurance, and auditability. Now, there is risk here, and it's important to say it. If crypto becomes financial infrastructure, it may also become more controlled through regulation, KYC, institutional capture, permission systems, surveillance risk, and behave a lot more like traditional finance. So the next question is not just, does crypto get adopted? The next question is, what version of crypto gets adopted? Open, permissionless, bank-controlled, stablecoin rails, tokenized securities, AI agent payment systems? These are all not the same thing. And that's why this next phase is so important, because adoption alone is not the whole story. The design matters. So here's the thesis. Crypto is not just waiting for another bull market. It is being pulled into the financial system. And this is why the next cycle may look different. It's not going to be about retail mania. It may not be about which next coin gets listed. It may not be about who is the loudest community. It might be about infrastructure, stable coins, moving money, tokenized assets, moving collateral, access to different layered markets, AI agents moving value, and exchanges becoming regulated gateways, governments writing the rules, and retail still asking what coin pumps next. But if crypto really is becoming financial infrastructure, the biggest opportunities may not be where the noise is. They may be where the rails are being built. So the question I'd leave you with is simple. Are you watching crypto as a casino, or are you watching it as infrastructure? Because those are two very different ways to see the same market. And if this shift continues, the people who really understand the rails early may understand the next cycle before everyone else. If you like this video and you want to learn more about the crypto space, AI, regulated payments, crypto news, hacks, DeFi and more, please like this video and subscribe to my channel.